We're at the top of the economic cycle, especially in the US, for example, where arguably the US economy might be operating a little bit above its potential. And that has huge implications from an economic policy point of view. This is usually where inflation starts to heat up a bit. We haven't seen that yet, but usually you want to, once you reach full capacity in the economy, you're trying to now continue to maintain it at a cruising speed. You don't need to stimulate anymore. You need to keep things on a more neutral level with respect to economic policy. So what that means is that, and in Canada too, we're at full, going at more or less at full capacity. Again, to me, a really good indicator of that is our labor market with unemployment rate below 6%, which, I don't know, 2 or 3 years ago, I wouldn't have thought that we could sustain that. Now here we are again around the 6% overall in Canada, and that's despite still some weakness in some parts of Canada. Think of Alberta, that's still struggling in the energy sector, and the Saskatchewan as well, and Newfoundland. But overall, under 6%, that's to me a sign of overall strength, notwithstanding all the uncertainty. So that prompted, from, again, an economic policy point of view, prompted the Bank of Canada to say, look, we don't need to stimulate as much anymore. The economy is healthier. Let's shift that policy lever towards neutral. And neutral from an interest rate point of view is somewhere between 2.5% and 3.5%. There's a lot of discussion whether that really is kind of the zone for short-term interest rates. But as of now, and over the past several months, we're at 1.75%. So the Bank of Canada rate, so that's the policy rate that the Bank of Canada controls, is at 1.75%. In mid-2017, it was at 0.5%. So we've seen 5 increases of 0.25% since then. And the point was, look, we don't need to stimulate. Let's bring closer to neutral. However, given the uncertainty that we've seen over the last few months, the Bank of Canada, I think wisely, has decided to hit the pause button for now and said, we may not be at neutral levels quite yet, but let's take our time here. There's no rush. And the reason is inflation is still not a threat in Canada. The core measures of inflation are running roughly around 2%, which is where the bank, that's the midpoint for the Bank of Canada's target on inflation. So given there's no risk of a flare-up in inflation, the Bank of Canada says, well, okay, we've got a little bit of room to maneuver here. There's some concern about the global economy and the uncertainty in global financial markets. Let's take our time here. Let's hit the pause button. And so in our view, we think the Bank of Canada is done for this year and probably all of next year as well at 1.75%. So we're not going to go back to somewhere in the range of 2.5% and 3.5% for short-term interest rates. And that's a change. We've changed that call not that long ago, just a couple of weeks ago. So it's still pretty new for me to think, because my message was a pause for a short period of time, and then the Bank of Canada will continue to raise interest rates. Ultimately, the bank will probably want to bring interest rates a little bit lower, a little bit higher. But at this point, there's no urgency for the bank to do it. So expect interest rates to stay more or less where they are today. We've seen longer-term interest rate. Now, if you're in the market to buy a home, you're looking for or renew your mortgage, we've seen over the last a couple months or last few weeks that fixed mortgage rates, for example, have come down a little bit. There might be a little bit of scope for them to pick up a little bit, but not that much. We're roughly in the zone where we're going to be, in our view, over the next year and a half with respect to interest rate. So it will have implications for businesses. It will have implications in particular for households who carry, and I'm going to get to it in a moment, but for households who carry a lot of debt. So in the context of rising interest rate, it means spending a lot more on interest, for example. Now it's going to be a little bit less so than we thought previously.